U.S. Bank account terminations, risk policies, consumer impacts, and mitigation. 1. Overview of recent closures. Banks and card issuers are terminating or freezing large numbers of consumer accounts, with funds in some cases inaccessible for weeks or months. Institutions attribute actions to internal rules addressing reputational and operational risk rather than explicit viewpoint discrimination. Footnote. This section establishes the factual premise that widespread closures and prolonged fund holds are occurring and are officially justified by risk frameworks rather than politics. 2. Institutional rationale and risk policies. Closures reflect enterprise risk controls that integrate anti-fraud, anti-money laundering, know your customer, and reputational risk scoring. Where aggregate risk exceeds policy thresholds, banks may terminate relationships, freeze access pending review, or decline transactions without advance notice. Footnote. This section identifies the policy architecture, fraud, AML, KYC, and reputation screens, through which institutions operationalize termination decisions. 3. Common triggers reported by consumers. Reported catalysts include account inactivity, misflags on store cards, perceived bonus seeking or churning on rewards accounts with forfeiture of miles or points upon closure, remittances to higher risk jurisdictions that prompt fraud reviews, large cross-border cash deposits, and credit score declines after paying off installment debt that lead to card suspensions or closures. Footnote. This section catalogs recurring fact patterns that precipitate shutdowns even absent proven wrongdoing, including rewards behavior, remittances, and score volatility. 4. Consequences of closure or freeze. Immediate effects include loss of payment access, delayed return of funds, reversal or forfeiture of accumulated rewards, adverse liquidity shocks for consumers with a single banking relationship, and potential downstream credit impacts where limits are reduced or accounts are closed. Footnote. This section details consumer harms such as immobilized deposits, reward loss, and cash flow interruption when a sole account is affected. 5. Contractual discretion and review outcomes. Standard account agreements reserve broad discretion to close, restrict, or not renew accounts. Investigations may culminate in permanent closure with a mailed check for residual balances, and appeal avenues are often limited where institutions characterize the decision as final. Footnote. This section explains that contractual terms typically authorize unilateral termination, with post-review outcomes ranging from reinstatement to non-appealable closure. 6. Risk mitigation for consumers. Prudent measures include maintaining multiple bank relationships, preserving an emergency liquidity buffer outside the primary institution, spacing large deposits and documenting lawful sources of funds, pre-notifying banks of cross-border activity, avoiding clustered new account bonuses, keeping modest recurring activity on store or co-branded cards, and monitoring credit to avoid sudden score drops that may trigger automated cuts. Footnote. This section provides operational steps to reduce shutdown probability and to cushion liquidity risk if a termination occurs. 7. Contingency planning and redress. Consumers should prepare a backup payment and deposit pathway, promptly request written reasons for adverse actions, and track timelines for release of held funds. Where appropriate, they may pursue internal escalation and file supervisory complaints with relevant regulators to seek review of process or delay. Footnote. This section outlines post-closure process management and external complaint options aimed at accelerating fund release or obtaining institutional reconsideration. Bank account closure contingency checklist. 1. Maintain at least 2 active checking accounts at different institutions. 2. Keep 1 to 2 months' expenses in a backup account or money market fund. 3. Set up duplicate payment rails, debit card, credit card, and ACH from each bank. 4. Use light recurring activity on store or co-branded cards to avoid inactivity flags. 5. Pre-notify banks of cross-border transfers or atypical deposits, keep documentation. 6. Avoid clustered new account bonuses, space applications by 60 to 90 days. 7. Keep ID docs, proof of address, and source of funds files in a secure folder. 8. Monitor credit weekly, watch for sharp score drops after paying off loans. 9. Enable alerts for balance, transfer, and sign-in changes at all institutions. 10. Test your Plan B account quarterly with a small direct deposit and bill pay.